Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. I mean, we're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow.
Generating profits in a recession is a challenging task that takes courage, but there is one individual who has mastered it. Warren Buffett, widely recognized as one of the world's most successful investors, has already experienced one recession or another in his lifetime and gained valuable experience along the way. Buffett's investment approach has been primarily built upon the principles of value investing, where he seeks out stocks that are trading below their intrinsic value. With a straightforward ideology guiding his investment decisions, Buffett has consistently achieved remarkable success over the years. The basic ideas of investing are to look at stocks as business, use the market's fluctuations to your advantage, and seek a margin of safety. 100 years from now, they will still be the cornerstones of investing. Let's dive into Buffett's first principle. Know that the markets bounce back. Buffett often takes a contrarian approach during recessions, capitalizing on market pessimism and buying when others are selling. He believes in being fearful when others are greedy and greedy when others are fearful, taking advantage of lower prices and potential bargains.
When stocks are down, we're going to be buying on balance, and who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
While it may sound simple, taking advantage of opportunities during a crisis requires more than mere words. However, it is crucial to recognize that every crisis, including recessions, can present possibilities for profit. It is important to remember that markets have a history of bouncing back, as evident in the aftermath of the 2008 global financial crisis. Despite a 37% drop in the S&P 500 in 2008, the following year witnessed a significant rebound of 26%. Even when considering data going back 91 years, the same pattern holds true, including during the challenging times of the Great Depression. Also interesting, only 5% of people who watch my videos are actually subscribed. So if you are included in the 95% of viewers who aren't subscribed yet, go ahead and reverse those numbers. It's completely free and helps out a ton. Lastly, feed a like to the algorithm. Interestingly, recessions have created more millionaires than the lottery. This is largely due to the fact that during a recession, various assets and investments become available at discounted prices, providing ample opportunities for those who are prepared to seize them and utilize the regression toward the mean. Be fearful when others are greedy and greedy when others are fearful. His advice is the following. Investors who avoid high and unnecessary costs and simply sit for an extended period with a collection of large, conservatively financed American businesses will almost certainly do well. He continues, businesses will indeed suffer earnings hiccups as they always have, but most major companies will be setting new profit records for 5, 10, and 20 years from now. Let's look at one of Warren Buffett's most notable investments, Coca-Cola, to illustrate this point. Prior to the recession in 2007, Coca-Cola stock reached an impressive high of nearly $32 per share. During the economic downturn, the stock price fell to $20 per share by March 2009. Let's see how Coca-Cola's core business changed during this period of about a year and a half. The company's products continued to be successful, and its global distribution and brand presence remained intact. There were minimal changes to the fundamental aspects of the business. What changed instead was investor sentiment and perception of the company, which was primarily influenced by the prevailing fear and uncertainty about the economic future. Investors who had the foresight to look beyond the fear and seize the opportunity by acquiring Coca-Cola stock were richly rewarded. Currently, the stock is valued at over $60 per share, underscoring the remarkable return potential that comes from taking a long-term investment perspective and withstanding short-term fears.
If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Buffett keeps a significant amount of cash reserves available to take advantage of investment opportunities that arise during recessions or market downturns. Cash provides flexibility and liquidity to capitalize on attractive investments or to provide support to existing investments during challenging times. Examining Berkshire Hathaway's balance sheet, Buffett's company, reveals a substantial allocation to cash and cash equivalents, alongside short-term investments that have high liquidity and can be easily converted into cash. This liquidity provides Berkshire with the flexibility to seize opportunities by investing in undervalued stocks.
You literally every day have thousands of the major American corporations offered to you at a price, and a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25, and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, swing.
Buffett takes a long-term approach to investing, focusing on businesses that he believes have enduring value. He looks for companies with strong competitive advantages, solid management teams, and consistent earnings potential, even during economic downturns. During recessions, odds are that companies with strong balance sheets, healthy cash balances, and growing revenues are priced at a discount. With a commitment to long-term goals, recessions offer advantageous opportunities to acquire premium shares that can enhance your investment portfolio. In the grand scheme of things, stocks have a tendency to outpace inflation and bounce back from downturns by a significant margin. But it's a marathon, not a sprint. Buffett is known to say that his favorite stockholding period is forever. The difference between gambling and investing lies in understanding a company's fundamentals. Risk comes from not knowing what you're doing. You don't need to have extraordinary stock-picking abilities. When companies experience a decline in their stock prices from recent highs, it is essential to investigate the underlying reasons. Determine whether their performance has genuinely deteriorated or if it is merely a consequence of an economic slowdown. A first and simple way to assess this is to take a step back and look at the bigger picture. Evaluate the overall performance of the industry and major indices. Do they also face challenges, or is it primarily limited to this particular company? The most promising investment opportunities often arise in the middle of a recession. Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price. In 2010, Buffett encouraged confidence and said to investors, "We're still in a recession. We're not going to be out of it for a while, but we will get out." It is important to remember that nothing is permanent. Even in times when it looks like the economy will continue to shrink, it is important to remember that there is always a silver lining.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes
selling
down?
a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, "I'll pay you 15," you don't sell it because the quote's 15.
Buffett emphasizes the importance of patience and discipline in investing. He does not try to time the market or make short-term trades based on economic conditions. Instead, he takes a long-term view, focusing on the fundamentals of companies. When people run for the hills, it's important to stay disciplined and not let emotions get in the way. The stock market is the only store where when things go on sale, everyone runs out the door. You don't want to be one of those people. During the global financial crisis in 2008, a common reaction among many investors was to hastily withdraw their money from the stock market. Unfortunately, this reaction almost always is a bad move. It compounds the initial mistake of not having a diversified portfolio with a subsequent error, buying when prices are high and selling when they are low. Predicting the future is quite difficult for investors, as they frequently fall into the trap of reacting excessively to immediate problems. While the market may show irrational behavior in the short term, it tends to be rational over the long run. While bubbles may expand and eventually burst, investing for the long term, one can enjoy the benefits and rewards. Google is known to be the most used search engine in the world, and everything typed in there can be tracked. This offers the opportunity to use the data to gain insights into current trends. Data is the new currency. During the 2008 period, there was a widespread trend of individuals selling their houses. As a result, many turned to Google, searching for terms like "sell my house fast." Timing played a crucial role in this scenario. The key lies in seizing opportunities during such periods. That's when favorable opportunities emerge. In every crisis, there's an opportunity. Contrarily, when the majority is trying to buy, it becomes an opportune time to consider selling your assets. Let's take a look at Sir John Templeton, who is a prime example and known for his ability to look at the most difficult circumstances and find a way to leverage them for the greater good. He embodied the essence of contrarian investing, advocating buying stocks at the point of maximum pessimism. While others succumbed to the belief that the world was about to collapse, Templeton saw the perfect time to invest and take advantage of the growth potential. In 1939, he embarked on a bold experiment to validate his theory. Templeton was brave enough to invest all of his hard-earned savings and even borrowed additional funds to purchase $100 worth of every stock valued at $1 or below on the New York exchanges. This audacious portfolio would eventually serve as the foundation for his immense personal fortune and the creation of a thriving asset management empire. When the world's greatest depression had just ended, there were many bankrupt companies. He bet that there would be a high demand for almost all of them in the following years. Of the 104 stocks he bought, 100 made a profit, and only 4 made a loss. Bear markets start on the time of pessimism. They rise on the time of skepticism. They mature on the time of optimism. And they end on the time of euphoria. Such feelings are ubiquitous in any bull market and serve as important indicators of its direction. They provide valuable insights into the current market situation. This allows you to see if the market is relatively safe or if it has risen to alarming heights. Such insight is critical to making informed decisions about your investments. Many investors are unsure when to buy and when to sell. Templeton's principle is simple. You part ways with an asset only when you believe you have discovered another asset that offers a significantly superior value, say, a 50% better bargain. The continuous search for favorable opportunities on the market is an essential part of the investment strategy. Simultaneously, you assess your existing holdings. If you find that any item on your current list represents a 50% less compelling opportunity compared to the newly discovered asset, you make the decision to sell the former and acquire the latter. On average, a major nation experiences a significant bear market twice in 12 years. However, these downturns do not always coincide in all countries. Therefore, you can mitigate the impact of an economic downturn in a single country by holding a diversified portfolio with investments spread across multiple countries. Unlike an individual who has concentrated investments in one country, you are not forced to bear the full brunt of a downturn in a particular market. And if you're now wondering what to watch next, have a look at this video on screen I handpicked for you. Anyway, thanks for watching. Like and subscribe.